The typical investor who shies away from the listed REIT market is doing so because of concerns around volatility. And what we have done at CenterSquare is really try to educate our investors that volatility is actually a source of alpha. And it is as true today as it has ever been.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. In today's episode, I'm joined by the CEO of CenterSquare Investment Management, Todd Briddell, to hear his thoughts on the state of the listed real estate markets. Todd joined CenterSquare in 1993 and founded the firm's listed real estate securities group and served as a driver of both the public and private investment platforms. Todd, it's great to have you on the podcast today.
Sarah, I'm delighted to spend some time with you. Thank you.
So, Todd, the firm's REIT strategy marked its 30th anniversary last year. Could you talk a bit about how that strategy began and how it has evolved over the past 3 decades?
It's remarkable that it's been 3 decades. It makes me feel old to think about it that way, but I was really fortunate to launch that business so early in my career. And I think the way that we saw the real estate market evolving in the early 1990s is that it was a period where there were a lot of IPOs that were happening as a need for capital existed following the late 80s savings and loan crisis. And we saw an opportunity to develop a strategy that would be liquid, that would give us the ability to underwrite assets and management at the same time, and thought that we would be in a position ultimately, if we did it well, to generate some consistent returns for our investors. And we were aiming always to be an active manager. It was one of the first questions we asked is, could active management work? And I'm really happy to say that over the past 30 years, our team has done an absolutely spectacular job underwriting companies, assessing market conditions, knowing what we don't know in periods of high volatility and uncertainty, positioning the portfolio defensively at the right time periods, not getting over our skis when it comes to the way that we're positioned at any moment in time, being innovative in the way that we approach valuation, being, I think, a good sounding board with REIT management teams as to what's important, and developing a strategy that over the past 30 years has not only outperformed the benchmark, but substantially outperformed the private real estate benchmarks. And so we're really proud of the things that we've done over the past 30 years. But I think from a strategy, from an actual investment strategy itself, I think it's been remarkably consistent and evolved through a large amount of effort of team members with refinement. But I think at the end of the day, the key thing that we have as a selling point is consistency, the consistency of that approach over the past 30 years.
And it sounds like the strategy is very well aligned given the volatility that we're seeing today. Are you having to make any sorts of adjustments?
We've always had to make adjustments in the portfolio, and we always have a good idea of what we don't know. And there are always periods of uncertainty. And I think that people describe any moment in time as a period of great uncertainty. And today is certainly one of those periods of great uncertainty. But it's not new to us. We've lived through from the Russian debt crisis to the global financial crisis, through COVID, through whatever we're facing today with the largest backup of interest rates and then a settlement in terms of where inflation might end up being. So there's always these remarkable changes that are happening in and around the world that impact real estate or other sectors. And these changes might be interest rate driven, they might be inflation driven, they might be driven historically by supply concerns. Supply and debt are typically the two things that really disrupt real estate cycles. And more recently, we've seen some serious changes in the way that demand is unfolding and the big events that can happen from the outside that might impact demand. And all you need to look at is the office market, over the past 6 or 7 years to see the demand destruction that's taken place. So it's constantly changing. It's a real challenge. It keeps our people on their toes. And I think what has made it work for us is finding alpha opportunities, the ability to generate excess returns by converting volatility into alpha and looking for opportunities when everybody is looking to sell. It just might be the best time for us to be buying.
And you mentioned a whole slew of IPOs when the firm was just getting started. How have conditions changed over the years? What's the outlook right now?
That there's a broader question that I think about, Sarah, when it comes to that, and some perspective that I have that if you give me a minute, I'll share some of that perspective. So if you rewind the clock 50 years, you had loaded mutual funds with high fees and active management. And that has evolved in what I would refer to as a vanguardization of the public markets. So you've seen fees on loads go away. You've seen active management fees go down. You've seen the adoption of index mutual funds. You've seen the adoption of ETFs. And that fee compression over the past 50 years had a response. The investment industry's response to fee compression was very much an adoption of more private products that could have more fulsome fees, could differentiate themselves, that could go to investors with lower volatility, at least lower reported volatility. And so what's happened in the past, I think 15 years or so, there was a good period where REITs had a very strong constituency of investors. And some of that investor constituency has been eroded a bit as a result of the adoption of private market products. And the private market products benefited in the lead up to the global financial crisis. And even since then, by using a greater amount of low-cost secured lending. And so the REIT market lost a little bit of a cost of capital advantage because the REIT market tends to operate with substantially lower leverage than does the private market. So what that has meant is that the marginal buyer for an asset that would be interesting and compelling, the private market had a lower cost of capital simply because it used substantially greater leverage. And that dynamic really continued and resulted in a lot of poor decisions following COVID. When interest rates were really low, the private market stepped in and bought a lot of assets at bases that were super high and with assumptions that interest rates would be low forever. And the public market really, I think, was quite disciplined during that time period. And as a consequence, you saw really high returns early in the private market and less interesting returns out of the public market because that constituency was being a little bit eroded. Where we sit today is, I think we're at an interesting inflection point. And that inflection point is that some of those private strategies, particularly those private strategies that were aiming to provide liquidity to investors, are being challenged. They're being challenged to have liquidity for their investors. And they're also being challenged by investors who are questioning the marks that are being used in the private market. And there is a very good amount of evidence that those marks should have come down faster and further than they ultimately did. Now, our theory back starting in 1994, 1995, when we got going, is that if the public market trades at a premium, it will have a cost of capital advantage to the private market and be able to acquire assets accretively. If the opposite is true, and the public market is trading at a discount, then participants will look at the public market, the discount that exists, and have a motivation to be able to acquire those companies. And ultimately, that ends up creating effectively upward and lower bounds on how high and how low REITs can ultimately trade relative to net asset value. But it's a massive spread. And that spread can be plus or minus, let's say, 25% if measured on net asset value. Now, your question about IPOs is really conditioned upon the sector and whether that sector is in favor. If you look today in March of 2026, some of the sectors that are in favor, you'd have to look at senior housing and healthcare within the REIT space and say, wow, they're actually enjoying a fairly meaningful cost of capital advantage, namely lower cost of capital because of higher equity multiples and very attractive unsecured bond financing rates. And so they're able to make acquisitions today that I think are likely to be accretive to their earnings and that really demonstrate the cost of capital advantage that they have relative to the private market. So there's an IPO that's scheduled in the senior housing space this spring. And not surprisingly, that senior housing property type is going to be well received by investors. So I think there will be time periods where the REIT market will have a cost of capital advantage and be able to see an IPO. And it won't happen for every sector at every moment in time. But there are a couple sectors today that I think are really gaining some momentum. And I think as they gain momentum, have a cost of capital advantage, demonstrate that they can make accretive acquisitions and be a value creator potentially in development or other strategies, those companies are going to enjoy a long period of cost of capital advantage, trade above net asset value, and therefore motivate bankers and owners of similar type assets to look at the REIT market as a very attractive place to be able to secure capital. So that's my take on the IPO market. There have been few and far between. A lot of that comes down to the differential in cost of capital, comes down to the motivations of people in that pendulum swing between the public market and the private market that has existed for a long period of time. And I think we're going to have a period of time going forward where some of the private market wrappers that have been used in the past that have not provided the liquidity, have not provided, I think, the more accurate accounting of value may fall out of favor. And when we look back on the record over a 30-year time period of returns that have been generated from the public REIT market relative to private products, some of those private products have underperformed dramatically. I think investors are going to be increasingly asking themselves the question of why they're jumping through as many hoops as they are to invest in an illiquid product that was supposed to be open and provide liquidity when it hasn't actually generated the type of return history that would compete with the public REIT market that actually truly is liquid.
And Todd, just going back to the IPO, you mentioned activity in the healthcare sector. Which other sectors do you think could be candidates for activity?
Yeah, I think data center space needs a tremendous amount of capital. I think it's going to have to operate with greater leverage. I think the REIT market is going to have to figure out whether it is more comfortable with longer dated duration leverage and assets of the type that data centers represent. So I think that data centers continue to be quite interesting. We have an internal debate within CenterSquare as to whether the government will ultimately end up providing the type of financial guarantees that you see in Fannie and Freddie in order to support development of data centers going forward in the United States. I could see the Department of Energy providing those type of guarantees to be able to provide an advantage to the United States in having data centers developed here locally. That may include fabrication as well. So I think between senior housing and data centers, those are two likely areas that we would expect to see development of IPOs. We were invested in a private company that we thought was going to go public and ultimately ended up being sold to a very large constituents of investors. And we were a little disappointed that it didn't go public, but we were happy to have made the return on investment during its period as a private company. And it made sense for us and other shareholders to see that liquidity. But I think the data center market is going to be very interesting going forward.
And in your mind, is there a sort of optimal balance between listed and private real estate in investment portfolios today?
I think it's really up to each investor as to how they want to balance those two things. I think every LP, every pension fund and institution should take a moment to look back at the balance that they've had between public and private and ask themselves whether they've generated the results that they wanted and expected out of each of them. The typical investor who shies away from the listed REIT market is doing so because of concerns around volatility. And what we have done at CenterSquare is really try to educate our investors that volatility is actually a source of alpha. And it is as true today as it has ever been. If you take the typical private GP, and we are also at CenterSquare big investors in private real estate assets. Private real estate GPs today are actually wishing secretly that there were more pain, more volatility, more stress, more distress in the private markets, more banks foreclosing, more opportunities to be the next Sam Zell, taking advantage of that volatility and stress to be the next grave dancer to buy private assets at really inexpensive prices. And the volatility just doesn't exist in the private market the way that people wished that it did. And when it does exist in the public market, many times it has nothing to do with the underlying fundamentals of real estate: supply, demand, occupancy, rental rate, cash flow growth. It has more to do with just general market volatility that frankly impacts all assets, whether they're public or private. It's just that they get reflected in prices more quickly in the public market. And so from our perspective, it is a bountiful set of opportunities that exist during those periods of volatility if you're prepared, if you're disciplined, and if you're willing to step in during those moments. I think investors will ultimately really come to appreciate having a balanced approach between public and private. And I'm seeing that more and more, particularly for non-US investors. And in 2025 was a remarkable year for seeing non-US institutions really embracing the global public REIT market as a solution for building out their real asset strategy long term.
And I also wanted to ask you about the balance between US and global as opposed to private and listed.
Yeah, I think a lot of the answer to that question for most LPs, it comes down to where their underlying liabilities are, what their market environment looks like. If you're an institution running a large Social Security administration in a relatively small market in Asia or in Europe, et cetera, you're going to absolutely need to invest beyond your own shores. You see the Australians doing that, and clearly you see folks out of the Middle East doing the same thing and taking a global perspective. And so most of them, when looking at building a listed strategy, are doing so from a global perspective. And I think that makes a lot of sense. They are taking the widest approach possible. Some of them, however, may adopt hiring one manager for one market and another manager for another market. But I think they ultimately end up landing on having one manager looking over their portfolio from a global basis. And I think that non-US investors are going to continue to have a global perspective. I think US investors tend to be a little bit more insular in their thinking and a little less likely to adopt a global benchmark and investment strategy for matching their liabilities.
Todd, I'd love to hear your thoughts on AI, how it's reshaping the real estate landscape, how the industry is really prepared to deal with all the changes coming.
I'd like to know the answer to those questions as well. And what I can share with you is that when I look back over the last 30, 40 years, let's go back to the age in which the internet didn't exist. Information was the key critical differentiator. How do you get information? It was you'd fly into a market, you'd meet with brokers, you'd meet with owners of assets, you'd meet with leasing people. You'd get a sense of a market supply picture. You'd capture any piece of information that you possibly could in the most analog way possible. So information was the critical advantage for a long period of time prior to the internet. When the internet became really commonplace, information followed very quickly, and that information was no longer the critical advantage. It was the ability to assimilate that information into a decision, into a strategy. What I mean by that is you could collect all the information, then it was a question of like information overload. And that was a common phrase when the internet came out and information became available. People were at information overload, and then a question of what to do with it. And we had analog systems, X, Y in Excel, to be able to try to look at that data. And what's happened in the last couple of years is that the assimilation of information is changing exponentially. And AI allows that assimilation to take place in robust ways that I think very few managers were able to embrace because of the high cost. And I think it's going to follow a very similar approach to information democratizing the way that investors can approach the market. The assimilation of that information is being democratized by things like Claude, the Claude app program that came out in January. And the world is now embracing AI, and the assimilation curve has changed exponentially. The things that we can do now with data are really quite remarkable. And I think that the moats that people thought that they had are going to change dramatically going forward. Nearly every system that predated this time period when it came to assimilating data may become obsolete. And so now we need to think about what the post-assimilation time period looks like. Will all of these systems yield decisions that look like we're all following the herd? Will everyone effectively take a adoption of the same strategy at the same time? And how will we, as owners of real estate, investors on behalf of the institutions, need to separate ourselves to move from assimilating data so that we're all effectively following the same model to post-assimilation world where we're reapplying wisdom into the thinking. And I think it's going to be very interesting. And I think that for, a firm like CenterSquare, clearly we're thinking about how to be more efficient in processes. I got it, right? And we're all thinking also about how to be smarter with investment decisions and wanting to avoid following the herd in doing so. And what happens beyond that in terms of contrarian thinking and what a post-assimilation of data looks like is the question that I'm struggling the most with right now.
Todd, we've covered lots of ground, lots of really interesting topics. Any closing thoughts, say, on the outlook for REITs overall at the moment and perhaps where the industry's heading in the next few years?
Yeah, I think the sea changes that and the big tectonic shifts that we're seeing today among institutions, and I'm going to talk about institutions, then I'll get to kind of the retail investor in a second. But the typical institution right now is a little dissatisfied with the product wrapper that they've been sold in private real estate, whether it be in open-ended funds or closed-end funds that are not providing the experiences that they were looking for, or at least they're inconsistent manager to manager. And I think that there's an opportunity for the REIT market and for the REIT industry to make sure that it steps into that dissatisfaction sentiment that exists and position the REIT market in a way that people understand the returns that have been generated historically, that volatility should be embraced, not feared, as a source of alpha, and that it is such a more dynamic marketplace than the private real estate market has been. It's much more innovative. If you look at the weightings of office and how those have changed over time, at one point in time they were 40%, and now they're 4% or whatever they are today. The voting machine of shareholders has a dramatic impact, and I think keeps the REIT market with those companies performing at the best in larger positions, relatively speaking, to those who are not performing at their best. Before I get to retail investors, I'd give a cautionary note to every REIT CEO, okay? If you're growth-oriented, if you're innovative, if you are a true value creator, then you're earning your G&A. If you have become a steward or a sheep herder, where your responsibility is just to tend to your flock of real estate assets and to hoard them and to not innovate, to not grow, to not be a value creator, then public shareholders are going to have and use their voting machines, and they're going to sell your stock. So you must be thinking, if you are wanting to command premium compensation and premium levels of G&A, you must have a growth mindset, innovate, and add value. Otherwise, shareholders are going to be dissatisfied and either vote by selling your shares or vote against your proxies. So be mindful of that. Please be value creators, be innovative, be growth mindseted. Okay, now for the average high net worth investor that's out there, the pretzel twisting that is happening to create private products where they exist for the public REIT market is mind-boggling to me. The REIT market represents a really wonderful democratization of institutional quality real estate for investors. And I'd like to have that debate anytime, anywhere with the constituents that are lining up to create really high cost strategies for the mass affluent and retail investors and question whose interests are they serving. So those are my parting thoughts for you, Sarah.
As you say, a huge topic that we can explore on another time.
Yes. Thank you, Sarah.
Thank you, Todd. Thank you so much. And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.